All right, so get ready because we're diving deep into like 1981,
Oh, wow.
Warren Buffett's letter to Berkshire Hathaway shareholders.
Yeah?
I always love going back and reading this stuff. It's
Yeah.
like
That's a good one.
getting a master class in investing straight from the Oracle of Omaha himself.
Yeah, and what always gets me is how much of what he was talking about back then
Oh, yeah.
still resonates today,
Yeah.
even though things were so different back then.
Oh, totally. A completely different world.
Wildly different economic landscape.
Can you imagine
Yeah.
inflation going bonkers and then interest rates like hitting double digits?
Oh, yeah, it was crazy.
It's unheard of.
Talk about a roller coaster ride.
So picture this. You're an investor.
Mm-hmm.
It's 1981. Things are uncertain, and then you get this letter from Buffett, and he's not just like, going on about like boring financial numbers.
Yeah.
He's dropping all this wisdom about how to navigate these like crazy times.
Totally.
And I think one of the biggest things he talks about that still matters so much today is this whole idea of non-controlled ownership earnings.
Yeah. Yeah, that one sometimes throws people off.
Yeah.
Because it sounds way more complicated than it really is.
Yeah, it sounds very jargony.
Yeah. Buffett's really just talking about the earnings that the companies you own stock in are making,
Okay.
even if you're not seeing that cash directly as a dividend.
Okay, so like, say I'm holding on to some Amazon stock.
Mm-hmm.
Does that mean like every time their cloud computing division makes billions of dollars, I'm getting a check in the mail?
Probably not, no.
Okay.
No, not quite.
Okay.
Those earnings are being reinvested by Amazon,
Okay.
hopefully in ways that grow the business and ultimately increase the value of your shares.
Gotcha.
It's like owning a slice of a pizza place.
Okay.
You might not be pocketing all the profit every day,
Right.
but that dough is being used to buy better ovens, maybe open a new location,
Okay.
all of which makes your slice more valuable over time.
So these invisible earnings, it's like the secret ingredient to long-term investing.
Yeah, and this was especially crucial back then because inflation was so high.
Oh, totally.
Like, think about it this way. Imagine you've got $1 today
Okay.
and you bury it in your backyard a year from now. You dig it up, you've still got $1, right?
Yeah.
But because of inflation, that dollar can't buy you as much candy as it could a year ago.
Exactly. Inflation is a monster.
It's true.
But if that dollar was invested in a company that was using its earnings wisely, growing and increasing its value, then theoretically your investment will have outpaced that candy-stealing monster.
Precisely.
Okay.
And Buffett pointed to companies like Geico and the Washington Post Company back then as examples of businesses that were doing just that.
Smart.
Reinvesting their earnings, effectively building intrinsic value, even as the value of the dollar itself was shrinking.
So he's not just saying, hey, hope for the best while this like crazy inflation eats your lunch.
No.
He's saying like, here's how you can actually beat it.
This is how you can come out ahead.
Yeah. But here's where I think it gets really interesting because he kind of changes his tune on this whole retained earnings thing later in the letter.
He does, yeah. And this is where you really start to see how those high interest rates were changing the game for businesses.
Oh.
Because back then, investors could get a really good return just by parking their money in bonds,
Okay.
like a guaranteed 10% or more.
Wow.
So suddenly that company reinvesting its earnings at, say, 8% doesn't look so hot.
Yeah, it's like the bar for a good investment just got raised like ridiculously high.
Exactly what was once considered a decent return now looks pretty pathetic
Yeah.
compared to what you could get elsewhere. And that's the point that Buffett really drives home in this letter.
Yeah.
He even breaks out the math.
He loves to do that.
And you know how much he loves his numbers?
Oh, yeah.
Showing how even a 14% return on equity, which sounds pretty good on paper, might not actually be beating inflation and taxes in that kind of high interest rate environment.
Oof. Yeah. It's one thing to think about it like in theory,
Yeah.
but then when you actually see the numbers,
Yeah.
it makes it real.
It's painful.
It's like, oh, man.
And that's where I think that whole tapeworm analogy comes in.
Oh, yeah.
The tapeworm.
It's a little gross.
It's kind of gross, but man, does it.
But it's effective.
It really sticks with you.
It does.
This idea that inflation is like this,
Silent killer.
yeah, this invisible parasite.
Feasting on profits.
Yeah.
No matter how good the business might look from the outside.
Totally. Even if you're like crushing it,
Right.
inflation's in the background, like,
Lurking.
yeah, taking little bites
It's taking its cut.
out of every dollar.
And this is something that Buffett really hammers home in this letter. Yeah.
Even companies that are posting like decent earnings
Right.
were basically being forced to hoard cash.
Okay.
Not because they were being greedy or anything,
Right.
but just to keep up with these rising costs.
Yeah, wow. Yeah.
They were essentially feeding the tapeworm.
It's like that scene in Indiana Jones where he thinks he's escaped and then all of a sudden, boom.
Giant boulder.
This giant boulder.
Yeah.
But instead of a boulder, it's inflation coming at you.
And that's why, as Buffett points out, dividends were scarce during this period.
Really?
Companies weren't necessarily being stingy.
Okay.
They were just in survival mode.
Wow. So we've got inflation.
Yeah.
We've got interest rates that are crazy high.
Through the roof.
And we've got companies battling this tapeworm. It sounds like a recipe for disaster.
It does.
Yeah.
But then Buffett throws us another curveball.
Okay.
He starts talking about CEOs making bad acquisitions.
Oh, yeah.
The kissing toad section.
I love that.
This is classic Buffett, witty, insightful.
Yeah.
And a little bit brutal.
Yeah, he doesn't hold back.
No, he doesn't.
He basically compares CEOs chasing these deals to princesses desperately kissing toads.
Yeah, hoping they'll magically transform into princes.
It's so good. And he lays out these reasons why managers make these decisions, and I think they're so insightful.
Yeah.
The first one, the thrill of the chase.
Yeah, who doesn't love a good chase?
Right, these mega deals. It's exciting.
It's exciting. It's an adrenaline rush.
Yeah.
The bigger the deal,
yeah,
the bigger the ego boost.
And then the second reason he gives is that there's just this ingrained belief that bigger is always better.
Oh, yeah.
Even if it, makes no sense.
Even if the numbers just don't add up, bigger is better.
And then finally, he says that some CEOs just have this unshakable faith in themselves.
They think they can fix anything.
They're like, I'm a genius.
I've got the magic touch.
Yeah, one kiss and this toad's gonna turn into a prince.
It's gonna happen. I can feel it.
Spoiler alert.
Yeah.
Doesn't really work that way.
Rarely works out that way.
But I do appreciate that Buffett does say, okay, there are exceptions.
Right.
There are those companies that thrive in those times.
Right.
And there are those exceptional managers.
Yes, the managerial superstars.
Yeah. That can actually find those diamonds in the rough.
Right.
But I also love that he admits that even he didn't buy enough of those companies.
Yeah, he was too focused on the toads, I guess.
Right. Even Warren Buffett is saying,
yeah,
I didn't get it totally right.
I missed out.
Which is refreshing.
It is. He's very candid about that.
Yeah. And then the way he talks about these managers, you can just hear.
He's like a kid in a candy store.
He's like, I love this guy.
I know.
He calls out Tom Murphy.
Yeah, Tom Murphy of Capital Cities.
And he's like, this guy gets it.
He's the real deal.
He's like, he's not kissing toads.
Well, he's finding the princes.
He's finding those princes. And it's like, okay, so these people exist.
Yeah.
But don't bet everything on finding them.
Right.
You're probably dealing with a toad.
Exactly. Be realistic. Don't let the hype cloud your judgment.
Yeah, and this is where I think it gets really interesting because then he kind of brings it back to Berkshire. And he's like, here's how we're handling this.
Right, because now everyone's on the edge of their seat.
Totally.
What is Berkshire doing?
So how does Buffett reassure shareholders who are probably
yeah, they're freaking out.
Freaking out a little bit.
Yeah.
After that whole roller coaster ride.
So he levels with them.
Right.
He's like, look, even Berkshire's feeling the heat.
Okay.
It's getting harder to beat these passive returns.
Yeah.
But we're still clearing the bar.
Okay, so no need to panic just yet.
Not yet.
But he also makes it clear that Berkshire's not just hoarding cash.
Right.
Because of this tapeworm.
Yeah, they're not just trying to stay afloat. Yeah. They're still all about growth.
They want to grow.
Yeah. He emphasizes that they're sitting on all this cash, not because they're afraid to invest.
Okay.
But because they're being incredibly picky.
Oh.
About where they put their money.
Makes sense.
Which sounds familiar, right?
Oh, yeah.
Classic Buffett.
It's like he's saying,
don't mistake caution for fear.
Right.
We're not retreating.
Yeah.
We're just being strategic.
We're being smart.
This is where we get a glimpse into Buffett's thinking when it comes to how he views shareholders.
Okay.
So he announces this new program.
Okay.
Shareholder designated charitable contributions.
Okay, so what does that mean?
He's basically giving shareholders a say in where a portion of Berkshire's charitable donations go.
Wow, that's crazy.
That's pretty wild, right?
How many CEOs are doing that?
Not many.
Yeah, it really shows you how much he trusts the Berkshire shareholders.
He's like, you're not just along for the ride.
Yeah.
We value your input, even when it comes to this stuff.
It's really interesting. And I also thought it was interesting that,
What's
no one really took him up on it.
That's right.
They were fine.
Nobody took him up on that offer to, redirect their portion of the charitable giving.
Everyone was like, you know what? You got it, Warren.
Warren, you do it.
We trust you.
You have the magic touch.
We trust your judgment.
Yeah.
What a vote of confidence.
That's amazing. And I think he even says, like,
Yeah.
who came up with this great idea?
Oh, yeah. Who does he credit with this brainchild?
Charlie.
Charlie Munger, his right-hand man.
It's always Charlie.
It really highlights how strong their partnership is. They're the dream team.
The mutual respect.
Yeah.
The shared vision.
It makes you think that that's how you...
That's how you build an empire.
Yeah.
With a partnership like that.
It makes you realize that Buffett's not just giving us like an economics lesson.
Not just an investing playbook.
Or like how to invest.
Right.
Right.
He's sharing a philosophy.
It's a way of thinking.
Yeah.
About business and life. Really.
He's saying, like, it's not just about the numbers.
It's about the why.
Yeah.
Behind the numbers.
The values.
It's about building something that's going to last.
Okay.
Something you can be proud of.
Yeah.
Financially and ethically.
It's about finding those companies that aren't just trying to run away from inflation.
Right.
They're making the world a better place.
It's not just about outrunning the tapeworm.
Yeah. It's about making a difference.
Yeah.
That's a good place to end it, don't you think?
I think that's a great place to end it. What a great discussion.
This was fun.
This was awesome. Until next time.